Are you tired of watching your friends make thousands of dollars in the stock market while you're still trying to figure out where to invest your hard-earned cash? The truth is, 80% of individual investors lose money in the stock market, while a simple index fund can earn you an average of 7% returns per year. So, where should you put your 0.000 for maximum returns? Index funds are a type of investment that pools money from many investors to purchase a representative sample of stocks or bonds from a specific market index, such as the S&P 500. This means you're essentially buying a small piece of the entire market, rather than trying to pick individual winners. For example, if you invest 0.000 in an S&P 500 index fund, you'll own a tiny piece of companies like Apple, Microsoft, and Amazon. Historically, the S&P 500 has returned an average of 10% per year over the long term, making it a solid choice for investors. On the other hand, investing in individual stocks can be a high-risk, high-reward game. If you pick a winner, you could earn returns of 50% or more in a single year. However, if you pick a loser, you could lose 50% or more of your investment. For instance, in 2020, investors who put their money into Tesla stock saw returns of over 700%, while those who invested in Hertz saw their stock price plummet to nearly zero. The key is to understand that individual stocks are subject to a wide range of factors, from company performance to industry trends and economic conditions. One of the biggest advantages of index funds is diversification. By owning a small piece of hundreds or even thousands of different stocks, you're spreading your risk and increasing your potential for long-term returns. This is because different stocks and industries perform well at different times, so a diversified portfolio can help you smooth out the ups and downs of the market. For example, if you invest 0.000 in a total stock market index fund, you'll own a piece of nearly every publicly traded company in the U.S., from tech giants like Google to consumer staples like Procter & Gamble. Another important factor to consider is the cost of investing. Individual stocks often come with high trading fees and commissions, which can eat into your returns over time. Index funds, on the other hand, typically have much lower fees, since they're simply tracking a market index rather than trying to actively pick winners. For instance, the Vanguard 500 Index Fund has an expense ratio of just 0.04%, which means you'll pay just per year for every 0.000 you invest. So, how do index funds and individual stocks perform in the real world? Let's look at a few examples. In 2020, the S&P 500 Index Fund returned around 16%, while the average individual stock investor saw returns of just 4%. Over the long term, the numbers are even more striking. According to a study by Charles Schwab, investors who put their money into a total stock market index fund from 2000 to 2020 saw average returns of 7.5% per year, while those who tried to pick individual stocks saw average returns of just 2.5% per year. So, how can you get started with index funds or individual stocks? The first step is to open a brokerage account with a reputable online broker, such as Fidelity or Vanguard. From there, you can choose from a wide range of index funds or individual stocks and start investing with as little as 0.0. For example, you could invest 0.000 in a Vanguard S&P 500 index fund, or spread your money across a few individual stocks like Amazon, Microsoft, and Johnson & Johnson. In conclusion, index funds and individual stocks both have their pros and cons. While individual stocks offer the potential for high returns, they also come with high risks and fees. Index funds, on the other hand, offer broad diversification and low costs, making them a solid choice for long-term investors. Ultimately, the key is to understand your own risk tolerance and investment goals, and to choose the investment strategy that works best for you. Thanks for watching. If you're ready to start building wealth with index funds or individual stocks, be sure to like and subscribe for more investing tips and tutorials. And if you have any questions or comments, please leave them in the section below. Don't forget to check out our next video on retirement investing, and we'll see you in the next one.